You can run a company for 2 decades and hold it and still make oodles of money. Every month is a liquidity event if you do it right. We got to the 11th hour and we were about to sign the contract. And he's like, hey, the powers that be at Chase want us to do a site visit because we're about to sign the contract. So we want to make sure that your office is real. I'm like, oh crap, we got Costco folding tables, right? They flew in on the jet, and I knew they were big college football fans. And Boise obviously has Boise State, which is the only blue turf football field. So I called my friend who was the president of Boise State at the time. Hey, you've got that boardroom that overlooks the football field. Can I use it? I vividly remember Mike Duffy saying, oh crap, we never went to your office. I'm like, oh yeah, we didn't. So they never saw the plastic folding tables, and we got our deal done with Chase as a 1-year-old company. You bought us because we're fast and we move fast, and you put all these other businesses under us and products under us because we're fast and we're innovative, and then you put handcuffs on us.
Welcome to Turpentine Finance, a podcast where we talk with top founders and finance leaders about what it takes to architect success. Our guests speak candidly about big business inflections, market curveballs, and how they approach decision-making so that you have the tactics and mental models for when the pressure is on. I'm your host, Sasha Orloff, founder, CEO, and self-professed finance nerd. You ready? Let's dive in. Hello, everybody. So, startups are ultimately decided as successful about whether or not they return capital to the founders, investors, and employees. And return of capital is unfortunately a far more elusive thing than it should be, given the size of the venture and the private equity industry. So just to set some context, according to PitchBook, the Wall Street Journal, and CB Insights, there are 5.5 million new businesses launched each year. 50,000 of them raise capital. 75% of those are venture-backed startups that never return capital to investors. And of the remaining, 50% return less than the capital invested, 20% return 1 to 2x, 15% return 2 to 5x, and 15% return 5x, which is bonkers when you kind of think about it. And so we've come to this place where we start to celebrate fundraising headlines all the time, and we've been accustomed that this is like an exciting part. But in this episode, let's celebrate success. Actual, real success, return of capital success, the success that we all want as founders, investors, and employees. And my guest today, Brad, has had lots of successes over his career, but starting as a lawyer at the prestigious Holland & Hart, chairman of the board of the Salt Lake City branch of the Federal Reserve, running multiple companies. And I really want to focus this episode on one of those companies, Kount, which might be one of the most successful and first AI acquisitions of all time, which Brad bootstrapped and sold for $640 million. So Brad, welcome to the show. I'm excited to have you.
Thanks, Sasha. Honored to be here. It's good to see you, my friend.
Yeah, good to see you. All right. So the starting story of Kount comes from the starting story of Kinetics. What's Kinetics?
Kinetics is actually a holding company for what was originally one operating subsidiary, which is a company called ClickBank. It was a large online retailer of digital goods. I took it over after practicing law at Holland & Hart as CEO. That was my first gig in business. It was a small company. I think we had 24 employees at the time, really early stage. We frankly grew the heck out of it, ended up with several $100 million in revenue in a relatively short period of time. And it was in a rough space. It was in digital goods because we were selling only digital goods. It was selling ebooks before Kindle. I remember when I had to give a speech in Germany at the World Book Fair, and everybody was like, what are these ebooks? No one will ever read an ebook. And I'm like, well, I think they might. And then, now I kind of look like I was really smart. But ebooks, membership sites, etc. And that was back in the early 2000s. Anyway, we were in a rough neighborhood, digital goods. And I say rough neighborhood because there's a lot of fraud with digital goods. They're usually testing sites for physical goods, for testing sites for stolen credit cards, etc. So we developed our own fraud solution, and we were a very sizable customer for Chase Payment Tech. And I remember I was at dinner with the CEO of Chase, then CEO of Chase, Mike Duffy, who was a very good and close friend of mine. And we were in Dallas, and he said, what do you guys do for fraud control? I'm like, why do you ask? He said, well, you literally live in the roughest neighborhood in e-commerce, and you have the lowest fraud rate of any of our portfolio companies. And you're in a top 1% of our portfolio companies. I'm like, oh yeah, well, we invented our own stuff. We have patents on it. He said, if you could bottle that, you could make a fortune. So flew home met with the original founder of ClickBank and Kinetics, Tim Barber, he and his ex-wife, and the angel investor who invested $120,000. That's what they started it with. And talk about an ROI. They've received hundreds of millions in dividends subsequently. So pretty good for a $120,000 investment. Anyway, we met at a sushi restaurant at Vista up on Vista Road, right next to the airport in Boise, Idaho, where we lived. And I landed from Dallas and said, hey, this is what the CEO said. If we could bottle our fraud control, we could make a fortune. Let's bottle our fraud control. So we sat at a sushi restaurant and figured out how we were going to take the fraud control system that we were leveraging already, supervised and unsupervised machine, for ClickBank, and turn it into a standalone product. And we founded Kount.
Wow. That is incredible. And sort of, it was amazing because you had to build it and make it work for your own business.
Totally. I think those are the best businesses where you create them to cover your own behind. And because you take it super seriously, right? You make sure the product works right and you're customer facing because you're the customer.
So what if we think about sort of Kinetics as well, were there other companies held under the holding company as well?
We were using it as an incubator. We came up with several other ideas that we either built and then used elsewhere or sold, or technologies that were sold. But the two main operating companies were ClickBank and Kount, and I ran both for several years until we did our A round. We never raised any institutional money for ClickBank. It was literally the $120,000 was all that was ever invested. And then it was profitable in year one and still fantastically profitable. And then I'm still on the board.
Just in case the listeners didn't hear, it's still incredibly profitable with 120,000 investment.
Yeah, you can do it. You can run a company for 2 decades and hold it and still make oodles of money. Every month is a liquidity event if you do it right. And so I ran both until we did the first institutional round. Our A round at Kount was CVC out of their growth fund, and they invested $80 million, and that was our A round for Kount, and A and only round.
Wow. So how do you know when you have a company that is working like that and it's profitable, how do you know to raise money, or why do you raise money?
We probably didn't need to raise money in order to accelerate the growth of the business. What we needed was the credibility, the connections that come with raising money from the right people. And we knew that if we raised with the right people, it would help us accelerate our international growth, which is why one of the main reasons we chose CVC, because they're in 28 countries. Nobody's ever heard of them, but they're one of the top 5 PEs in the world. They just raised the largest fund out of anyone anywhere in the world, the $29 billion fund. And it was also to enhance the board, because once we got the right people around the board table from an investor perspective, they also brought with them. We had the former CEO of Symantec on our board, this little company in Boise, Idaho, right? And Linda Faden Levinson, who was simultaneously on our board and the board of NCR and Hertz, and she's on a board of this early stage company in Boise, Idaho, and she was just actually received the National Association of Corporate Directors Lifetime Achievement Award for her board service last year. It's like we had these outsized, fantastic board members that helped us really grow a better business and help me become a much better CEO. So we raised money not necessarily for the money, because everybody's money is green. We raised it for the credibility that it brought us and the relationships that it brought us and the business improvement that it facilitated.
And how do you, so one of the aspects is having sort of this global connections, and it sounds like CVC is obviously quite strong there and well capitalized. When you were going out to consider raising, did you think about sort of the difference, venture capital versus private equity, and what were some of the differences there? And as you do, well, yeah, let's start there.
We did. We had really the spectrum of institutional investors around the table. We had some venture. We were actually invested in out of CVC's growth fund. I think we were their second investment out of their growth fund. And it just, at the end of the day, the calculation really wasn't whether I'm going to go venture, who has a different risk profile, obviously, than growth or private equity. It was really which partners were going to be around the table. And I tell this to entrepreneurs all the time. It's, the fund matters, but what matters more is the partner and who's going to be in the board, because you're going to spend a lot of time with that person or those people, and stuff's going to happen. It's business. Bad things will happen. And are they going to be the type of people that shoot at you or jump in the foxhole with you and shoot with you? And you have to do some diligence to figure that out. But I had the two partners from CVC that were on our board were two of the highest quality people that I've ever worked with in my career. Not just financially brilliant and business savvy, wonderful human beings who, when my family had a major crisis and my wife almost died, one of the partners we were on vacation in Virginia in the middle of nowhere with two young kids. And he got on a plane, unbeknownst to me, flew to Virginia, had never met my kids, and took my kids to amusement parks and fed them ice cream for days while their mom was in the hospital. At that point, we thought dying. And that is a quality human being that you want around a table with you, who cares not just about whether you get them a great return on their investment, but also is a lifelong friend.
That's amazing. And I think something that a lot of us would aspire to, both on either side of the table, as a board member or wanting of our board members as founders. And so when you're first going out, so you're sort of the first kind of two factors that we talked about is having this kind of global presence, because fraud isn't just a Boise, Idaho thing or a San Francisco thing. It's a global thing. Having capital. Is there a discussion at the time about how much to raise, whether it's a minority or a majority stake? I think there's this perception with private equity that it's only a buyout majority sort of thing, and you're using this actually as kind of a catalyst to build a huge company.
Yeah, there was a pretty significant discussion, how much is primary, how much is secondary. With us, by way of full disclosure, I subsequently sold Kount to Equifax, and I worked for them for 2.5 years, ran their Equifax digital solutions arm, which was Kount and a bunch of other solutions in fraud, compliance, underwriting, etc. And then 6 months ago, I joined CVC as a partner, an investment partner. They call me an industrial partner because I came out of industry instead of private equity. So full disclosure, I'm now with CVC, which is probably the biggest testament I can give to them because I loved them so much I wanted to be a part of them. But so with us, most people think that you're automatically going for a control stake, but it's about 50% of the time that we're control and 50% of the time that we're a minority stake. So they were open with us. We had a great asset. That always helps, obviously, going to the market when you're growing fast, profitable, have all the analysts say you're the best in class, customers think you're fantastic. That's a formula for having a good process. So everyone was pretty flexible with us as to whether they take a minority stake or a control stake. And we were able to just figure out what was best for us and our shareholders at that time. And we probably there was a significant portion that was secondary. And that was great for all of our original investors. And again, we bootstrapped it. So everybody ended up happy. And I mean, we really bootstrapped it. I remember there was a time when we were Boise Costco's largest consumer of plastic folding tables because they were the desk. And my favorite story about starting it up was the same guy who was my friend, who was the CEO of Payment Tech. In year one, our first customer was out of the chute, first trade show when we launched, was Staples, who was the number 2 online retailer in the world at the time. And right out of the chute. And I was like, holy crap, we're onto something here. And then my buddy, who was the CEO of Payment Tech, who was at the time 51% of the world's card not present transactions, reached out and said, wow, your stuff is great. I'm like, yeah, I know. He's like, well, we ought to use you. And at that point, no payment processor, acquiring bank, PayFac, gateway, or anything had integrated fraud control. So it was a whole new thing. And so we started talking about it and decided we were going to do it. And we got to the 11th hour and we were about to sign the contract. And he's like, hey, the powers that be at Chase want us to do a site visit because we're about to sign a contract to run. We were part of the auth stream transactions through startup. I'm like, yeah, so we want to make sure that your office is real. I'm like, oh crap, we got Costco folding tables, right? So they were all big college football fans and they flew in on the jet. And I knew they were big college football fans. And Boise obviously has Boise State, which is the only blue turf football field. And so it's unique. So I called my friend who was the president of Boise State at the time, Bob Custer, and said, "Hey, you've got that boardroom that overlooks the football field. Can I use it?" He's like, "Sure." So I picked him up at the corporate airport. And I'm like, instead of meeting in our office, I know you're all college football fans. We're going to have our meeting in the boardroom overlooking the Smurf turf. And they're like, "No way, so cool." So we had the meeting with them all day overlooking the turf. And then I took them to my club for dinner. And then we took them home. And then the next day, we had them in the president's suite watching the Boise State Oregon football game, University of Oregon football game, which was a huge game. And they had a blast. And then I took them straight from there to the airport. And I vividly remember Mike Duffy saying, "Oh crap, we never went to your office." I'm like, "Oh yeah, we didn't." Suffice it to say it's there. So they never saw the plastic folding tables, and we got our deal done with Chase as a 1-year-old company. So
I had a similar story when we had our first regulatory audit at one of my previous companies, and they said, "You need a locking drawer and you need a paper shredder." And I was like, "Well, we're entirely digital as a company." And they're like, "It's like on our checklist. Like we have to checklist." And so I said, "Yeah, no problem. Well, I'll show it to you." But when I was like, "Let's go get a coffee," and I went down and I went over and I was like, "Go across the street to Staples and go buy a locking box." And we just had it in the corner of a conference room, like on the floor, just take it out. And like there, and they're like, "Okay, check, check."
I mean, those are good times, though. Those are stories that will never get old. And you go back with the team at the time, and like, remember when we bought the lockbox and the shredder?
I'm going to tell the story in 12 years on a podcast with Brad.
Totally.
um, I want to, dispel a bit of a myth because you had a profitable company, you go to private equity, and sometimes there's this kind of reputation of spreadsheet operators, and it doesn't come with like a friendly connotation all the time, but you took the company and you grew it substantially, brought on more clients, had more capital, and sold it. But I imagine there's sort of it has to be a fear at some point in your mind that there's going to be this drastic change of culture pre and post investment. Can you talk a little bit about what actually changed and your perception of, was that a good thing, or what, any lessons learned?
So again, I did a lot of diligence on what it would mean and to work with the two partners in particular. So I knew what I was getting myself into. And I there I don't think there was a drastic change in the culture as a whole. We had a really unique culture. I'm a big believer in open, honest, and fearless communication. It was on every whiteboard. Like every Friday, I would write, you've probably read them, these weekly updates. There were long Brad stories about my youth, stupid stuff I did, and the 5 things I learned, and then how we could apply those 5 things that I learned when I was in college, being stupid, to what's going on in our business now. And then I would tell everybody in the company everything, the good, the bad, and the ugly, every single Friday. And I remember the first time people read that, they were like, "Wow, you really disclose a lot to like the receptionist, but to everyone." And I was like, "Yeah, well, everyone knows that they'll continue to get this unfettered access to everything going on in the business until I'm in downtown Boise and hear it from somebody else. And then we turn off the faucet." And I never ever had that experience. So that was the one area where I thought they'd kind of shut me down, but they didn't. And really, the culture didn't change anywhere except in the boardroom. And it was a net positive. I think the first couple board meetings where they were, they understood our business very, very well by the end of diligence. And they had legitimate questions, and they had some things that we'd never thought about, which is why you want them around the board table. And I think it was tough for me and my team for the first few months. I was like, wow, be careful what you ask for. You just might get it. But they were super helpful about and proactive about helping us get up to speed on the things we didn't know, and dedicated team members to come to Boise and help us. And it was a net positive, but otherwise they really didn't change our culture. In fact, if anything, they connected me with other CEOs in the portfolio to talk about culture and why our culture produced outlier results. And so I expected it to change more than it did. And I think the only way it changed was it forced my management team, and me in particular, to look at things from a different angle, which made me, if you're self-aware and you really want to grow your business and you personally, that's what you want. You don't want a board that's constantly just rubber stamping whatever you say or do. And
Any examples to really bring this to life?
Yeah, so Linda Fain Levinson, who was on the board who I talked about, who just got the Lifetime Achievement Award from the NACD. She said one time, I'm on all these boards, and she's on everybody's board, and nobody's ever run a good board meeting. And she goes, I think you're proactive enough that we can do some things together. I'm like, okay. So I sat down with her in New York one time over lunch. It was a long lunch, and we mapped out what a perfect board meeting would be. And we concluded, look, you've got all these really smart people that if you've done a board, if you organize the board properly. And almost without exception, you go into a board meeting and the management team goes through one by one by one, and they regurgitate the deck that the board was given a week before. And if they're good board members, they've already read it anyway. So she's like, what a waste of time. And they ask a few questions, and then you've got all these smart people who asked in a 3-4 hour period, 2 or 3 good questions, and then they go off on their merry way and you have a board dinner. So we upended it. So what we did was we created these decks, which are the normal decks, which went through everything. And my board was never surprised because they got the weekly updates with the good, the bad, and the ugly. So they knew everything going on anyway. And I had this rule where I would give the board good news within 24 hours and bad news within 1. And so they knew everything going on. So I would give them the deck and I would say, please review the deck. If you have any questions, get them to me by, 3 days before the board meeting. We'll spend the first 30 minutes addressing your questions. Well, they'd invariably ask the questions. I'd answer them via email. And we get to the board meeting, everything was resolved. So then the board meeting became the 3 things. And it was the 3 opportunities or the 3 challenges that we were facing. And it became an open discussion of all these really smart people on the board saying, okay, we're in a contract negotiation with this company. Have you ever seen it? What should I be looking for? How can I optimize it? Or this big customer is about to cram us down. We can see it coming. What should we do? Or there's this product opportunity. And you had all these really smart people in the room, and it got board buy-in. You learned a lot from the board, and the board meetings were actually super interactive and super positive and productive. So there were some tense moments where they didn't necessarily like my initial volley, but that's also what you want, right? So I think that was one of the things that made me be a better CEO and board member, because I started using a board, I think, properly.
Hey, we'll get back to the conversation in a moment after a word from our sponsors. Hey, finance leaders, do you remember when Amazon didn't have to charge sales tax on every online purchase? Well, 10 years later, we see sales tax on e-commerce everywhere. That wave is now hitting SaaS and the digital economy, and Anrock is here to help you navigate this new tax compliance journey. As your software business grows, so does your global tax liability. But keeping up with ever-changing regulations across multiple jurisdictions can be overwhelming. That's where Anrock comes in. Anrock is the enterprise-grade solution that automates sales tax compliance worldwide. Anrock tracks your exposure, calculates tax, and handles filings all in one platform. As a Turpentine Finance listener, you can get a free Nexus study from Anrock today. See your economic and physical nexus in real time by connecting your billing and HRIS tools. You'll get a clear view of your exact exposure in any jurisdiction, plus a live review with a SaaS tax expert. Don't let tax compliance slow down your growth. Visit anrock.com/turpentine to claim your free Nexus study and take control of your SaaS tax strategy. Anrock, empowering software businesses to grow across the globe.
Managing company expenses doesn't have to be a hassle. You can effortlessly streamline the entire expense management process, from receipt capture to approval routing and reimbursements, in a single solution. Enter Rippling Spend, the revolutionary platform trusted by thousands of businesses to take control of their finances. Backed by top investors and boasting over $1 billion in funding, they're dedicated to providing exceptional value to their customers. Here's how it works. An employee submits a lunch receipt via their Rippling app, and AI instantly turns it into an expense report, checking for policy compliance in real time to auto-approve or send directly to the approver based on your org chart. No more chasing receipts or manually routing approvals. Want to take it a step further? Automate your corporate card management with Rippling as well. You can automatically issue cards to employees with preset limits and specific policies, such as managers with a $50 team lunch limit. The rest is auto-rejected at the point of transaction. Then, every transaction syncs with your accounting system in real time. Plus, you earn market-leading rewards on every purchase, rewarding your company for everyday spending, all while closing your books 3 times faster. Ready to transform your company's spending? Sign up for a free demo at rippling.com/turpentine and get 1 month free. That's rippling.com/turpentine. Start your 1 month free trial today.
Over time, you're growing the business, it's becoming successful, you're closing clients. There's sometimes a discussion about sort of growing vertically or growing horizontally, meaning like just take the same product and either go up market, down market, let's expand internationally, or let's expand to new ideas. And so when you think back to your Kinetics days, there's some amount of time that you can sort of incubate and then maybe kill a project or invest in anything more. And a lot of times in early stage venture, at least in the Valley, there's an expectation you're going to keep raising and growing TAM and expanding along the way. Are there any sort of lessons learned or differences of opinion that you had as you were thinking about expanding new products or new features? And that hopefully then can lead up to the discussion about when's the right time to sell a company like you did to Equifax.
We had the luxury, I guess, of we were bootstrapping each of the products, but we had the luxury of having the financial wherewithal to do the initial work. So I think what we did right was we did pretty thorough market analysis before we launched a product. Before we launched Kount, we knew what we were going to launch right after the sushi lunch, but then we hired a consultant to go to the Internet Retail 100 and say, what are your points of pain when it comes to fraud? And we knew what it was for us. We knew what we had worked, but we didn't sell physical goods. So maybe there were some nuances there. So we went out and literally hired a consultant who went out and interviewed all these folks. And so when we launched, we knew the Staples of the world would want it because we built it for the Staples of the world. So we took a little more time than a lot of my friends who live in your neck of the woods, who are, I think, more aggressive than I was. And it wasn't that I wasn't aggressive. I was damn sure that we had a product market fit before we launched or before we even started writing code. So I think we were conservative about that. I think prudent maybe. And we just kind of did things differently. We walked through a lot of scenarios, and we were also willing to fail fast. Like there were things that we launched that we thought were going to be the greatest thing since sliced bread. We'd already evaluated it. And I learned the lesson the hard way that, yeah, somebody will say, oh yeah, I'd definitely pay for that. And then when you say, okay, we built it, you want to pay for it? They're like, oh, I don't really want to pay for it. So I think you have to be willing to recognize sometimes you make mistakes and either pivot or kill things fast.
How do you on that? So you're doing something fairly atypical, which is market research and validation before you start writing code. Should be best practices, like validate something has a demand before you theoretically think it is. Sometimes they work out and sometimes they don't. How do you know when to kill a project?
That's the hardest thing because no matter how mature you are, how self-aware you are, how confident you are, it's a failure. And you've got to be willing to say, okay, it's all opportunity cost. I have a finite number of developers. I can either keep plugging away at this thing, or I can take what we've built, maybe roll it into one of our other products and use it in a way that I wasn't originally intending it to be used, but maybe create a competitive advantage from one of our existing solutions, which we did once. I thought it was going to be the greatest thing since sliced bread. We did market research. We launched it with the team. I had cool t-shirts made for the launch day. Everybody was like all excited for launching this new product. And then 6 months later, I'm like, okay, psych, we're going to roll it under ClickBank and it's going to be a feature now that we actually made money on, but it was not what we originally intended to do. It was just, frankly, the cost benefit analysis of keeping this operational and putting in all the independently operational and sinking the additional funds into it, or putting them into something that we're already generating an enormous amount of revenue through. And you just have to be super mature and super disciplined about it. And we reviewed everything on a quarterly basis to make sure that we didn't need to do pivots. We didn't change our strategy quarterly, but we had half-day strategy updates on a quarterly basis in order to evaluate the strategy, make sure things were working, make sure the market hadn't changed, make sure what we were hearing from customers hadn't changed, and it enabled us to be a lot more agile and to make some hard decisions fast and call BS on each other. When we're like, all right, you're drinking your own Kool-Aid. Let's either pivot this or kill it. And we killed a few things. So
Sometimes when I made the comment before about sometimes PE is sort of thoughtful as like of a spreadsheet operator, like there's an ROI and that has a huge benefit to it along the way. Was there any discussion of that? Was that just part of your culture anyway? Or was there anything new to the evaluation of new projects or new launches that you thought that like a CVC, your partner, brought to the table that was different than how you thought about it previously?
yeah, they really helped us. We had too many, I would call them key growth drivers, and they helped us really narrow the scope to the 5 things that were the most important. And they helped us create discipline around managing the business with 180-day plans. So we would have our strategy, our goals, our strategy, our five key growth drivers, and then our 180-day plan under each of the 5 key growth drivers. And I remember the first time we created a 180-day plan, and they came back and they're like, "You have like 24 tactics for the next 180 days under each of the 5 things." I'm like, "Yeah." Like, okay, we know you guys do a lot, but basically they said, you're smoking crack. It's just not going to happen. So make it no more than 5. I'm like, what? No, we can do all these. Like, no, make it no more than 5. And they really helped us be disciplined about narrowing our focus and concentrating on the things that mattered the most to grow our business. And we'd already been successful at growing a few businesses as a team. And I was already an okay CEO, but I became slightly better than okay after all of their input, and it worked out really well. So, and the whole team, I think, improved. They just required us to be hyper focused, hyper disciplined, and keep our eye on the prize. And we eliminated really any shiny baubles as a direct result of their driving us towards being hyper concentrated.
Awesome. So yeah, let's talk about the acquisition and then let's reflect back on some of these lessons, like you said, that maybe you could have told pre-Brad to make you that better CEO and help our listeners become better CEOs and operators. So P is typically known to have a sort of a defined window when they want to exit. That's because of fund structure, and I'm sure you can shed some light here. When you decided to raise money, was that part of the discussion at the investment? I was like, here's how long I think, and then we should think about what exit strategies are.
They were, to be honest, somewhat evasive about that because I asked directly, "What's your hold?" And I don't think they were evasive in a bad way. They were evasive in a "it depends" way. Their target was really 5 years, and I knew that because I'd already asked a bunch of people, and that's pretty normal for growth equity / PE. And so I knew what it was ish. When we were coming in on the 5-year point, we were in the middle of COVID, and I thought, and everybody was just in lockdown. I mean, portfolio companies were all across the board with every institutional investor, going for lines of credit because nobody knew what was going to happen in the world, right? And certainly M&A markets, you couldn't do diligence, you couldn't go on site. But right before COVID, I think it was the month before, I was at a sporting event with a very senior person at one of the card brands who basically said, "Hey, we need to buy you. We need to buy you before the end of this year." And that was that was when just before the world started going to heck in a handbasket. And so we weren't going to go to market, but that prompted it. And then suddenly there was a flurry of interest. It's just kind of funny how those things happen. And so we ended up getting together as a board and deciding, okay, well, things are going well. Might as well test the market. We tested the market and there was a lot of interest. So we ended up with a process there. And it was started by card brands, and then the credit bureaus got involved in others. And we ended up selling to Equifax as a direct result of that. But it was a weird time. Like, Equifax bought us without ever having done any on-site diligence. It was all Zoom. So I would sit, and I tie flies because I'm a fly fisherman, and I would sit on Zoom calls, doing diligence calls, tying flies, doing them one after the next. And people would be like, "Hey, that's a cool fly. Like, can I have that one?" I'm like, "Sure." It was kind of totally kind of like underscoring the whole Idaho thing.
Totally.
but it worked. So, but we ended up closing like 5 years and a week after they invested. So we were basically dumb luck right on the window, and they had a really nice return. So
Yeah. So okay. So it's you're having dinner. The conversation starts. It seems like it could be sort of serious. Was there an offer that went to the board, or was it like a discussion that catalyzed the board discussion? Like, hey, we think this is a good thing. This could be good timing. Should we consider an IPO?
no, there wasn't an offer. It was just he made it clear that he intended to buy us by the end of the calendar year. So, like, well, if he's going to go after us, we might as well see if anybody else wants to own us too.
So you call a board meeting. Is this like you just wait till the next board meeting, or do you call a board meeting, or you just call a board member?
I called the board member. Like, again, I was super communicative with my board, so I let them know. I'm like, all right, I was in the Uber leaving the event, and I'm like, okay, here's what happened, and so I'm just letting you know, good news within 24 hours. And so we convened a board meeting a few days later and said, okay, what are we going to do with this, knowing that this is their intention, and this is someone who can make that size decision and with this card brand.
And then do you call bankers? Are you running it yourself? How does the process actually work?
We actually called bankers at that point. We'd already identified a couple of bankers that we wanted to work with. So when I was pre CVC, I had my group of bankers that I had regular updates with. And usually they would tell me more than I would tell them if you do it right, the banker calls, because they always like, oh, I'll never tell anybody anything, but every banker tells everybody everything. So you have to be very careful about what you tell them, but they'll spew. So you learn a lot about what's going on in your industry. And then this is one of the biggest things I did to grow the business, interestingly, was you also get inundated with the VCs and the PEs and the growth funds calling you, like, and they're regular and they will absorb your whole day if you let them. So I would end the first call with them, I'd update them, also keeping in mind that they tell everyone everything. And I would say, and they would say, well, we're interested if you ever go to market. I'm like, yeah, well, I'll put you on the list and we'll call you right after the friends of Kount. And they're like, what's a friend of Kount? I'm like, oh, those are the investors that have actually facilitated intros and gotten us business, because everybody's money is green. Everybody says they have contacts. Friends of Kount are people that they've proven that they have contacts. So within 24 hours of the calls, I'd immediately get introduced to portfolio companies, and it helped us drive business growth. And I literally kept the list of friends of Kount and how much revenue they generated. And I honored my word. And when we launched the process, I called the friends of Kount first. But I did the same thing with bankers. I'm like, well, yeah, well, because they always end the call, you've had a million banker calls. What can we do for you? Well, drive revenue.
drive revenue. Heard of a P&L? It's that first line on the top. I really like it.
Yeah. So we had two or three that we knew we wanted to talk to. We talked to the two or three, figured out which one was the right one under the circumstances, hired our banker, and then launched a process. And, I've been through several processes in my career, more than I'd like to admit. And they can be super distracting. And there's some bankers who want to, scorch the earth and send out, have you do 80 fireside chats. I prefer to do smaller ones, more directed to the most likely acquirers. And we did some things that were different because I was an M&A lawyer. From the day we incorporated, we kept an evergreen data room. So we kept it in accordance with a due diligence checklist. And so I had a data room the day we incorporated with every contract organized like a due diligence checklist. And so that when the time came, we could just say, yeah, here's access. And we did that with our law firm, which was Fenwick and West. And when the time came, we were ready. We were loaded for bear day one, so we didn't have to lose any time. I mean, we had to produce a SIM, but
yeah, always be prepared. So, what's the discussion like behind the scenes with the board meetings? I'm assuming not every offer or every interest is the exact same dollar amount. It's a place where you, as you mentioned before, are going to go work afterwards because their golden handcuffs have a term for a reason along the way. What can you share? I know it's sort of confidential. Anything you can share about the actual discussion and how you ended up choosing Equifax?
so the numbers weren't all the same, obviously. And I was fortunate because I picked the right partner in CVC, that they were probably more deferential to me than they should have been about where we ended up. And it was, okay, great. we, no matter what, we're going to get a great return, and our LPs are going to be super happy. And so, all else being equal, what's the right place for Kount to end up? And I said, well, Equifax has this an enormous amount of data on Brad Wiskirchen in the physical world. We have an enormous amount of data on Brad Wiskirchen in the digital world. And if you combine the two, then you can do a lot of things to help make e-commerce safer interactions, to drive security, to drive certainty. I always say 5% of CEOs have a fraud problem, 100% have a revenue problem. So we moved after the acquisition from providing fraud services to providing digital enablement to help drive revenue growth, combining the two data sets. So really it became clear to me that Kount's biggest opportunity going forward was going to be with Equifax as opposed to some of the other payments companies that were involved, even though the more logical acquirer probably for most people would have been a payments company. So we had those discussions about where was the right place to land. And the key was that my board knew they could trust me because I developed the trust over time. And if you're a smart acquirer, because then I flipped, right? Once I joined Equifax, I started acquiring companies under my business. And it's pretty easy to flip a CEO because they know you're their future boss. And if you flip them, they start, you don't even have to try. They immediately go from, I'm doing what's in the best interest of my shareholders and my board, to how do I impress my future boss? Well, I impress my future boss by giving him inside information. I'm like, dude, I didn't even ask for that. And so my board knew that I was never going to flip because I told them right out of the chute, I was an M&A lawyer. I know what people try to do. They try and flip me. I'm not going to be flipped. And we won't even discuss my personal comp until the deal is done, fully negotiated. And because I don't care, I'll be fine. The deal's going to make sure the Wiskirchen kids can go to college. So I was super open about it. And whenever anybody tried to flip me, I would actually let my board know that, they tried to flip me, but I told them no bueno. But the thing is, once I was on the buy side, I actually recognized the impression I got to people who were willing proactively to be flipped. And I was like, really? Like, you're going to work for me? Yeah, but am I going to trust you? So it went from, the discussions were very about the potential strategic acquirers were actually really fair, really open, really good, and really deferential to what was in the best interest of the company. But I think that was because of, again, the partners that we'd selected. Because I've got friends who've sold companies and they're just like, I don't care where you end up. Life sucks for you for the next 2 to 3 years. We're going to take the biggest number.
Yeah. That's great. I mean, I think it's sort of also, we've learned a lot of lessons about how to build trust through what you're doing at the time, building that trust and relationship. Also, discipline around building an incredible company and getting to a place where everybody can win. It doesn't have to be I win because you lose along the way. Just a couple small questions post-acquisition. So I was looking up, it looks like Equifax was founded in 1899, which was before even you were born.
Yep. 1 year before. 1 year before.
Tell me about, but I think one of the parts that sounds really encouraging is that there's still a huge team at Kount who is coming along outside of just the transaction. Like, this is their life and their jobs. There's probably a change in culture, but also an alignment in, like, you can actually make Kount better because of the data and the assets that are sitting inside of Equifax. How do you think about your 30, 60, 90 post acquisition to make the M&A successful beyond just the transaction itself?
That's a great question. It's hard, right? Because you're going from, we were 150 employees to suddenly you're part of a tens of thousands of employee company, right? With all that's heavily regulated, by the way. So, it's no longer, we all think this is a great idea, start coding. We all think this is a great idea, now go through the 37 approvals. Coding. So I'd say the 30-day plan didn't adequately factor that in on either the Equifax side or the Kount side. The key was that I had developed a very, very good relationship with Mark Begor, the CEO of Equifax. And at 30 days, he basically said, okay, what are your thoughts? I'm like, we're obnoxiously slow now. Like, you bought us because we're fast and we move fast. And you put all these other businesses under us and products under us because we're fast and we're innovative. And then you put handcuffs on us. So we'd started off fully matrixed like everybody else. And then he recognized that that wasn't the best idea. So he then took like product, which at the time was matrixed, and tech, which was matrixed, and all these things that were matrixed. And he said, okay, those groups are going to now report back to Brad, and we're going to keep this more standalone, and all these other businesses and products that we're putting under them, we're going to keep kind of standalone under what we're calling Equifax Digital Solutions now. And we're giving them the leeway to execute. So 30 days, I think we were naive about what it would take to integrate. 60 days, we'd pivoted already because we had a relationship of trust. And I knew that we were only going to get to do those things as long as we didn't abuse it and as long as we actually performed, right? So we had a unique situation. And in fact, the team is still here in Boise. They're a block away from where my office is now in the Kount building, downtown Boise. And when people are hired, they move from Atlanta to be on part of that team to Boise. And like, it's not one of those things where I think a lot of the team members are like, oh crap, are we going to, be assimilated by the Borg in Atlanta? But we weren't. And I see the team every day because I still park in the same building as they do. And I get my hug every morning from a few people, and people are seriously happy. I had a conversation with one of my senior leadership team members this morning, and she said, honestly, I'm super, super happy. And I would never have guessed. So I think it's been a huge success story within Equifax.
Yeah, both financially, and sounds like the product has taken off, has more capabilities, and people are still grooving. That's great. Reflecting back now, looking back from sort of the first investment through the exit, any surprises or anything you would have done differently?
I think I probably would have, and I was naive about this because, we'd bootstrapped everything with everything I'd run. We'd never, and I think what I would have done differently is in the process asked them, and I think they would have showed me their business case because, they're in the back end with all these analysts and consultants and everybody else creating a business case and their basically business plan. And I should have asked before closing to see it, which I didn't. And I actually haven't had anybody ask me for that now that I'm on this side of the fence. But it would have been good to be aligned and say, okay, why'd you assume this? And we're never going to do that. We might. And because I think the first month it was like, oh, I just assumed you meant X. And they said, I just assumed you meant Y. I think you're both trying to get a deal done, and it's like dating, right? You're both trying to put your best foot forward. And then you get married and you're like, oh, wait, you put the toilet paper on the other direction. And it's just simple questions that you can ask. That single thing, maybe a sit down before closing and saying, okay, let's walk through your assumptions and your plan and where you expect us to be. Because there's a number they expect you to be at, and the 12-month mark and the 24-month mark. We were fortunately way ahead of those. So like I freaking killed it after 12 months. And one of the directors told me what the plan was accidentally, I don't think, that he was supposed to. And I'm like, wow. I went back to the team like, we're freaking killing their plan. So much so that it's actually bad because we've set the tone in the first 12 months, and now we're screwed. There's no way we can do it for the next 12, right? So
The victim of your own success.
yeah, but I think that's the one thing I would have done is just like, let's make sure we're fully aligned on what the plan is, and let me, you don't do that in the 6th hour, but by about the 11th hour, you should probably ask that question. And I've never heard people ask it. You probably do, but that's because you're Sasha.
Whether you then end up making the decision to go to the other side of the table. I'm assuming the first thing you do is you're like, where's that file on Kount? Let me see the business case like day one. It is in my employment contract. I want access to the original. Actually, did you ever go look? Have you looked?
I've looked, yeah. I didn't look at the file, but I saw the plan ultimately, and I saw, and look, they had a great exit with us, which is probably why I work for them now. And we had a great rapport, and so they were super open with me. Like even after they sold Kount, we would still go fishing together because we used to go fishing. I got them all to come to Idaho and go fly fishing with me, and a couple, some of them got hooked. Others were like, "This is a super boring thing to do with your life," but they were super open with me before anyway. So
yeah. So now you're on this side of the table. You've been an operator for quite a while, running a couple of companies. What gets you excited about investing?
I tell people this all the time. I literally wake up before the alarm clock goes off every single day of my life because I'm excited to go to work. And that is not hyperbolic at all. I get to spend my days every day listening to entrepreneurs with really cool plans. And I'm different than the other guys who do what I do, which they admit very readily because I've been there, done that. And so what I get to do while everybody else is like asking, what's your gross margin? What's everything else? I'm like, so when I did that, here's where it blew up in my face. And so just here's a pointer, like this is where it's going to blow up. You might want to do this. This is what I did. And people love that. And so like, I get to spend my whole day listening to all kinds of cool businesses and helping them not make the mistakes that I made. And there's plenty to draw upon. And that's like the coolest thing you can do. I always told my team at Kount and everything else I've ever run, people will always rally behind a morally compelling value proposition, always. And so no matter what you do in business, if you can come up with a morally compelling way to articulate what you do, it's really easy to motivate your team. And I have the like most morally compelling value proposition. PE gets panned in the press, particularly right now. And I think people lose sight because they don't understand what it is. We're actually helping people grow their businesses and achieve their goals. And like without PE, I never would have been in a position where I was a senior leader at Equifax and changing the world and making digital interactions more secure. Like that's because of private equity. Now, there's lots of things that private equity has done wrong, but there's lots of things that everybody in every industry has done wrong. So I just love my gig because I get to help people all day, every day. And if you can't get excited about that, then there's something fundamentally wrong with you.
I agree. All right. So to wrap it up, you made a comment before, CVC is one of the largest, not the largest, because one of the largest funds of all time, global private equity house. What's the pitch? Why should we have a lot of CFOs and founders and listeners building amazing companies? Why should they come talk to Brad?
Well, look, we have the largest footprint, right? We're 29 offices in 28 countries, all kinds of assets. I'm in the technology group for obvious reasons, but we owned Formula One. We own the International Rugby League. We've owned Petco and Breitling watches and BJ's Wholesale. We've owned all kinds of things, payment process, PaySafe, all kinds of things. And what comes of that is connectivity and real connections. So when I would be in an RFP, I could reach out to CVC and say, hey, are there any partners that know Company X? And invariably somebody would know Company X or have been on the board of Company X or they owned Company X. And it was a material revenue growth accelerator, both domestically and internationally. And because the footprint was so broad, I'd say, hey, we're thinking about moving into Germany. Well, let's put you on the phone with our German team in Frankfurt and they'll help you. That's invaluable. Yeah, we got a lot of financial resources because we just raised the biggest fund ever, right? But anybody can cut the check. It's what they do to help you accelerate the growth of your business afterwards and who's around the table. So I made the best decision in my professional career when I chose to go with them, or I guess us now. And I've never been happier.
Yeah, well, I think incredible operating experience, a healthy sense of optimism, and $26 billion sounds like a compelling reason to reach out to Brad. How could people get a hold of you if they wanted?
Wiskirchen@cvc.com.
We'll put it in the show notes. Brad, thank you so much for sharing the knowledge and joining me today. Really appreciate it.
Thanks, my friend. Good to see you.
Thanks for tuning in to Turpentine Finance. Share it with your executive team, direct reports, friends, and family. And if you want to support the show, the best ways are to leave a review wherever you're listening and subscribe. Turpentine Finance is part of Turpentine, the podcast network behind Moment of Zen, Turpentine VC, Age of Miracles, and more. Shows for experts by experts in tech.